Welcome to Harbor Rock Wealth Management's Planning Tip of the Week. My name is Ruben Smith. This week we are going to be talking about lines of credit and specifically home equity lines of credit and portfolio lines of credit. As a financial planner, I feel it's important to position clients in a way that they can withstand the unforeseen. And a lot of times the unforeseen can be financially catastrophic. So whether it's a health event, whether it's a medical expense, unforeseen tax bill, there's a number of reasons why a line of credit could be beneficial to a client, and even all the way down to debt consolidation. As Americans, we're notoriously bad when it comes to managing credit cards and personal debt. So that's even come into play with a few of our recommendations in the past. As far as lines of credit, they provide, in my opinion, they provide a safety net, another tool in the toolkit, if you will, for clients to fall back on when life happens. As a planner, I often talk to clients about life happening. We look at a projection in their financial plan, and we can tell them that with pretty high certainty that this will not be the outcome just based off life happening. So whether it's unpredicted returns in the market, unpredicted life expenses or life events or expenses, that's why we have the importance of reviewing plans on a regular basis. But let's dive right into it as far as lines of credit and how I position with clients and some of the nuances behind both the home equity line of credit and the portfolio line of credit. A home equity line of credit is most common. It's essentially a line of credit against the equity in your home. Okay, so you have access to draw funds from the equity. And most of us in Southern California here and nationwide for that part have seen an increase in their home values. So this could be a good opportunity if you don't have a home equity line of credit to go ahead and apply for one, so that you have access to the safety net or to another source of funds if needed. So with a home equity line of credit, you can put these in place with an intention. So maybe you have a future expense coming up that you wanna pay for using the line of credit, like a home improvement. We talked about debt consolidation. There could be a number of reasons, or just to have purely as a safety net, which is often what we do for clients as they're entering into retirement. Once they enter into retirement, they no longer have that regular paycheck they're used to. And I want clients to have another resource to have access to, at least if nothing else, to model what it would look like to use a line of credit, as opposed to maybe spending down their cash or selling out of their portfolio or using a credit card. We certainly don't want revolving credit card debt. So. Why I like the lines of credit is there's typically lower interest rates than what you're going to find on your credit cards. Even a good rate on a credit card is going to be 12 to 15%. So home equity lines of credit are much lower than that. Also, when it comes to the payments or how you pay it back, there's flexible payment options where you can do interest only, you can do principal and interest. So depending on your monthly cash flow, you can customize the draw amount and your payments that way. And then you also only pay for what you draw. So if you only have a $10,000 balance, but you have a $100,000 line of credit, you're not paying on the full $100,000. So it's pretty flexible as far as that goes. Now, it does require full appraisal or full underwriting and appraisal of the property. Not a big deal. It is a little bit, if you haven't been through the loan process in the last decade, it's a little bit more involved, but with some patience and the right expectations, I think you can get through it. So be prepared to provide tax documents, W-2s if you're working, things like that. And then how home equity lines of credit work is you actually have what's called a draw period, and it's 10 years. So from the day that you get the line of credit, you have access to the line for 10 years. After that point, if you do have a balance on it, the bank will amortize the loan amortize the balance over a 20-year period. So, if you have a line of credit, you've had it in place for years, and you feel like you'll never use it, I would encourage you to extend it when it comes to the end of your draw period, if nothing else, just to have as a safety net. Then moving on to the portfolio lines of credit. Now, a portfolio line of credit, in my opinion, serves the same purpose. It can be a safety net. It can be a debt consolidation tool. It could also be a bridge loan, in my opinion. So we have a lot of clients that are business owners that maybe their accounts receivable is past due and they're waiting for an inflow of cash. They can take a line off or draw off their line of credit to help them get through that period. We also have clients that are heavily invested in real estate, and maybe an escrow is taking longer than expected. So this could be a good opportunity to take a small draw off the line of credit. It pads them through until everything checks out. The difference with a portfolio line of credit is that the collateral in this case is not your home; it's your portfolio. So it does not apply to IRA or retirement type assets. So this is specifically non-retirement or after-tax assets that would be held in your name individually, maybe jointly with the spouse, or if you have those types of assets held in your trust, that would apply as well. Again, you have flexible payments when it comes to the payoff structure or the payment structure with portfolio lines of credit. And then the line amount actually is determined based off of the underlying risk of the portfolio. For instance, if you had an account that consisted of one stock, there's more risk associated with one stock versus a portfolio of stocks. So there's a good chance that if you applied for a line of credit off of one stock, they would give you the lower end, which is around 50% industry average as far as lending value. Now, on the flip side, if you had a full basket of stocks, there's a good chance that you'd get a higher lending value, maybe closer to 60 or 65%. And then if you have more conservative investments built into the portfolio, like bonds or even cash instruments or cash equivalents, there's a chance that you can get anywhere from 70 to 80, even higher as far as lending value. Okay, so really a pretty cool tool that we use for our clients, because it puts them in a position where when life happens, they don't necessarily have to sell out of their portfolio to fund that event. Maybe it's not the right time to sell based off market value or tax implications potentially for selling it. Maybe they want to push that off until the following tax year. So there's a number of reasons that we've utilized these for clients or recommended these for clients. And again, it's another tool in the toolkit and a way to get creative around cash management and cash flow. So both of these are not intended, the home equity line of credit and the portfolio line of credit are not intended to replace traditional financing. So don't think of it for going out and buying a second home or anything like that. That's not really what it's for. It's really meant for shorter term needs. And I've had clients use these lines of credits for all sorts of things, whether it's weddings, taxes, new cars, flipping properties, real estate transactions. There's a number of things, but just keep in mind that there's some underlying risk associated with it, and you want to make sure that it's the right fit for you before applying for either one, the portfolio line of credit or the home equity line. And any other questions, feel free to reach out to us. We have discussions with clients all day long about both of these. We'd be happy to take a deeper dive on either of them for you. If there's any other topics out there that you would like us to discuss, we're open to that as well. So please reach out if you have any questions. Otherwise, we'll see you next week. Thanks for tuning in.